All right, Jenny Harrington. So put your market view into perspective along with Paul Tudor Jones today on this network, talking about the risk of inflation, how he sees it. David Einhorn sees the same thing, but maybe not as dramatic of a pullback for the market if rates do rise.
I think it's all about moderation, right? And so then I was watching yesterday's show, too, where you had Brad Gerstner on, and I feel like all three of them are taking a generally cautious stance, more or less. We're all long investors. We're all invested in the market. None of us are willing to get bearish. None of us are willing to, I think, take big short calls. But I think there's apprehension and hesitation out there. And that is because we don't really know what's going to happen with inflation. We don't know if it's going to be normal inflation to, 2.5% range. We don't know if it might get a little bit stronger than that. So I think there's just a lot of.
What if I told you it was going to be stronger? What if I told you it was going to be stronger? Because I think the risk is to the upside at this point. I think we can clearly say that. So if I told you that inflation was going to be hotter than you think for longer than you expect, how would that impact the way you're investing in the market? How would you advise people to play that?
Well, I think this is what's so cool and tricky about the environment that we're in now, right? As a dividend investor, historically, way back, you would hear interest rates going up, and what do you want to back off of? You'd historically want to back off of my kind of stocks. Historically, when interest rates and inflation are up a lot, you'd want to back off of the bond equivalents, the ones that produce a lot of income. But that's changed. And so what's getting hurt now by higher inflation and higher interest rates is actually the really high tech stocks that have been supported by the ability to borrow at super low rates. So if you told me, Scott, that you were sure that inflation was going to be up a lot and interest rates might follow that, I would actually back off of the trade that's worked so well over the past decade. I think that's been supported by unbelievable easy money. And easy money ultimately messes up that risk-reward profile, and it causes people to take more risk and be more comfortable taking risk than they were in the past. I equate it to, like, on the rare event when I'm actually winning at Monopoly versus my son, and I have like all this extra money. I buy a cabin on every property. I buy a tent, a hotel, whatever, on every property. Okay, fine. We play the National Parks edition. So I buy the properties all over, and I'm very cavalier with my risk taking in Monopoly. And I think if you were to tell me, like, that's kind of what's been going on, but if we have high inflation and we have higher interest rates, the risk-return equation that we've been playing with for the past decade, that starts to change. And where you want to take risk is going to be in a lot of the stocks that David was just talking about when he was saying, and I wrote it down, I thought it was such a good way to say it, where he said, I want to believe that the value of a company is still related to the cash flows, to the value of the assets. And he said, I think that over the past decade, saying growth has really just been, I invest in growth has been really a way just to say like, I don't care about valuations anymore. I think valuations and cash flows and asset values really start to matter when it costs you to borrow money.